Hello, everybody, and welcome to yet another video from Intermediate Accounting, 17th edition video walkthrough solution. This is exercise 3-5. This question comes from the Intermediate Accounting 17th edition textbook, authors Don Kiso, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors or of the textbook or of Wiley. Okay, so let's get to the party. All right, so right over here, we're now going to be at exercise 3-5. So we've got over here the ledger of Duggan Rental Agency on March 31st of the current year includes the following selected accounts before adjusting entries have been prepared. Okay, so we've got over here an analysis of the accounts shows the following. Okay, so the equipment depreciates $250 per month. 1/3 of the unearned rent was recognized as revenue during the quarter. Interest of $500 is accrued on the notes payable. Supplies on hand total $850. Insurance expires at the rate of $300 per month. Okay, so what's kind of bizarre here is that they're talking about the quarter. Are they talking about the year? And the reason is that before we go through and solve this question, we need to have a little bit of a better understanding in terms of how this is kind of working. So if you just excuse me for a moment, I'll get some clarification. Okay, so this is for the quarter. Okay, so this is, and what a quarter is, it's gonna be 3 months, right? So, and if you've ever seen a publicly traded company report, to look at one, if I go to sec.gov and going to sec.gov, if I type in, what I will notice is that if I go to Amazon, I can look over here at a Q. What is a Q? It basically stands for a quarterly report, right? So over here, this is their quarterly results. And generally, when you're showing an income statement, you'll show basically for the 3 months and then for the period of time up until the end of the year. Okay, so right over here, let's go back over here and take a look at where we are. Okay, so the equipment depreciates at $250 per month. So what would I do? So I'm just being asked to prepare adjusting journal entries, assuming the entries are made quarterly. So I didn't have to look too far. I just needed, I'm an idiot. I should have just read through the things a little bit more, but that's okay. Okay, so additional, okay, let's go ahead and do this. So when we do our adjusting entries, okay, and I'm assuming it's 331x1, I'm gonna go ahead and debit for this first one. It's gonna be, I'm gonna debit depreciation expense, okay, and remember, right, and I did this in exercise 3-2. This is a very important entry or a very important T account that you need to memorize so that you always get the right answer. Okay, so when I record depreciation expense, I debit depreciation expense. I'm going to credit accumulated depreciation on the equipment. Okay, debit, credit. And this is going to be 250 times 3 or 750. Right here, this is going to be to record depreciation expense. Okay. This is why I don't like a lot of the textbooks in accounting, because they do not require the algorithm, the questions don't require a journal entry explanation. Okay, 1/3 of the unearned rent was recognized as revenue during the quarter. Okay, so so I guess my question is that, did they already recognize it, or do we need to go through and recognize it? Just give me a moment. Okay, so what this says is what it should say is it says that 1/3 of the unearned rent should be recognized as revenue during the quarter. It's not was recognized, but it should be recognized. So if my unearned rent right is 9,300, and if it's 1/3, I'm going to multiply that by 1/3, and if I take 9,300 divide it by 3, I'm going to get 3,100. Okay, so what do I do here? To recognize rent revenue, I'm going to show this as a credit for 3,100. What do I debit? I debit unearned rent revenue. When we ever do adjusting journal entries, there's a couple of different rules. The most important rule over here is that these rules right over here, that the assets need to reflect their future economic benefit, that our liabilities need to reflect our future obligations, our expenses need to reflect what we used, revenues reflect what we've earned. We never touch cash. To record rent revenue. Okay. Move this down over here. All right. Let's go ahead and take a look at our next one. Next one over here. Interest of 500 is accrued on the notes payable. Okay, so again, if this were me asking the question, I would be telling you what the interest rate is, whatever else you may have. So this is just going to be interest expense, crediting interest payable. Okay, interest payable, or just interest payable. Okay, so right over here is 500 and 500, right? To show the use of funds, we're going to record an expense, which is going to be interest expense. Whenever we're doing adjusting journal entries, we never adjust cash. So I'm going to be going over here and crediting interest payable. Okay, supplies on hand total 850. Okay, so if I have supplies, my supplies were listed over here of 2,800. If my actual amount of supplies though on hand are 850, what do I need to do to get from here to here? Well, to get from 2,800 to 850, I'm going to need a credit for 1,950. So how do I do the adjusting journal entry? Well, I know I need to credit supplies for 1,950 to make sure that that balance is correct. And I'm going to debit supplies expense for 1,950. Right, and remember our supplies are an asset until our employees take them. Okay, I'm just kidding. I'm going to promote it, right? That we don't have those kind of problems in California with theft, do we? I don't know. Just don't do it. Not worth it. Okay, so insurance expires at the rate of $300 per month. So we know that we're doing this on a quarterly basis. So that means we're going to need to record 3 months of insurance expense. So right over here, this is going to be insurance expense, prepaid insurance. Okay, so right over here, it tells us expires at a rate of $300 per month. And this is going to be to record insurance expense. Okay. All right, and I included explanations, so you got that extra special treat today. Okay, just give me a moment. Okay, children, that's it for today. We're children of accounting, like children of the corn. Not that you would even get that reference, but if you do, it's just that much creepier. Okay, so that's it for today. And I want to thank you all for joining me here today. Thank you, Wiley. Big shout out to Wiley. Please do not forget to like and subscribe. If you would like some other solutions, feel free to ask in the comments, and have a great, so it's like this is on December 31st, 2021. So we're almost at the 2022 accounting party. So we'll see what happens. Have a great rest of your year, and I'll see you guys on the next accounting video. Have a good one.